Okay, so here's something that a lot of people in the precious metals community would be interested in, especially people in the United States. It has to do with self-directed IRAs and using them to store gold and silver coins, and using the IRAs to deliver some kind of a tax advantage. I've mentioned this before, and I think that this kind of practice is fraught with dangers. And this particular ruling from the United States Tax Court really highlights that. So this was a finding that was just handed down recently in the case of married couple Andrew McNulty and Donna McNulty against the Commissioner of the Internal Revenue Service. And it has to do with their tax returns in 2015 and 2016, which the IRS had audited, determined that they had inappropriately used IRAs, and now the IRS is coming after them for hundreds of thousands of dollars worth of back taxes and penalties. So I thought I'd read through this opinion from the United States Tax Court just to highlight some of the dangers that people would face if they do try to use an IRA, a self-directed IRA for gold and silver storage, and do it inappropriately. So basically, here's the overall story here. It says that they established a self-directed individual retirement account under IRC Section 408, directed assets to be held in the IRA, to invest in single-member limited liability company. There was another party that was the manager of the LLC, and her, meaning Mrs. McNulty, her IRA invested in it. She directed the LLC to purchase American Eagle coins and took physical possession of the coins. Now, R, which I believe here is the respondent or the commissioner of the IRS, determined that the company received taxable distributions equal to the cost of the American Eagle coins in the year that they received physical custody of them. There's no dispute that the value of the coins is equal to their cost. Now, he, meaning Mr. McNulty, directed his IRA to invest in American Eagle coins and a condominium through an LLC. But he conceded that he received taxable distributions from these transactions, but contested IRC Section 6662, the penalties for the failure to report the distributions. So the finding of the court was that they received taxable distributions from her self-directed IRA equal to the cost of the American Eagle coins upon her receipt of the coins, meaning when she got the coins delivered to her from company Miles Franklin, which will be discussed later in the case. And that they also held further that they're liable for IRC Section 6662 penalties for substantial understatements of income tax attributable to their failure to report taxable distributions from their IRAs. Okay, so let's read a little bit further. I'm just going to go to the highlighted sections here. Basically, it says, here's the background. It says, during 2015, petitioners decided to establish self-directed IRAs. Before doing so, they researched self-directed IRAs online, including having the IRA invest in American Eagle coins through an LLC owned by the IRA. During 2015 and 2016, Mr. McNulty used the funds from his IRA to invest in a condominium and American Eagle coins through an LLC structure. He engaged in prohibited transactions under Section 4975 with respect to his IRA. During 2015, he received taxable IRA distributions of $295,554 and reported $1,595 of these distributions in gross income. During 2016, he received taxable distributions of $21,862 and did not report any amount in gross income. In August 2015, Mrs. McNulty purchased services from Checkbook IRA LLC through its website that included assistance in establishing a self-directed IRA and forming an LLC to which she would transfer IRA funds through purchases of membership interests and then purchase American Eagle coins using IRA funds. During 2015, Checkbook's website advertised that an LLC owned by an IRA could invest in American Eagle coins, and IRA owners could hold the coins at their homes without tax consequences or penalties, so long as the coins were titled to an LLC. There are in the record no certificates of ownership for the American Eagle coins or any other documentation that establishes legal title. On August 19, 2015, Mrs. McNulty established a self-directed IRA using checkbook services and named Kingdom Trust Company the IRA custodian. Kingdom Trust is an independent qualified custodian under the Investment Advisors Act of 1940. On August 24, 2015, Checkbook formed Greenhill Holdings, LLC. Greenhill's Articles of Organization, which were filed with the Secretary of State of Rhode Island on August 25, 2015, state that Greenhill is a single-member LLC that is a disregarded entity for federal tax purposes, and its sole initial member was Mrs. McNulty's IRA. Petitioners were appointed Greenhill's initial managers and were the managers during 2015 and 2016. Now, the petitioners here are Mr. and Mrs. McNulty, by the way. The petitioner's personal residence is Greenhill's principal place of business. Greenhill opened a bank account over which petitioners had signatory authority. With Checkbook's assistance, Greenhill obtained a federal taxpayer identification number. So then it discusses the funding of this IRA. Mrs. McNulty exercised sole control over her IRA investment decisions. She funded the IRA through direct transfers from two qualified retirement accounts, an individual retirement annuity with MetLife, and an employer-sponsored Section 401 profit-sharing retirement plan. Upon Mrs. McNulty's instructions, $378,487 was transferred from the MetLife annuity to her IRA during 2015 and $48,375 from the 401k during 2016. Petitioners did not report any part of these transfers as gross income. Mrs. McNulty instructed Kingdom Trust to use her IRA funds to purchase membership interests in Greenhill. The IRA purchased membership interests on 3 occasions during 2015 and 2016. For each investment, Mrs. McNulty instructed Kingdom Trust to transfer the purchase price of the membership interests from the IRA to Greenhill's bank account. In turn, Mrs. McNulty, as the LLC's manager, had Greenhill use almost all of the funds to purchase American Eagle coins from Miles Franklin, an authorized coin dealer. The funds to purchase the coins were transferred from Greenhill's bank account to Miles Franklin. The invoices from Miles Franklin list Greenhill as the purchaser. However, the shipping labels identified Mrs. McNulty individually or along with her IRA as the recipient of the shipments. The coins were shipped to the petitioner's personal residence and were stored in a safe there, along with coins purchased with funds from Mr. McNulty's IRA and coins purchased by petitioners directly. The American Eagle coins purchased with funds from Mrs. McNulty's IRA through Greenhill were labeled as such. The first Greenhill investment and coin purchase occurred in August through September 2015, with the funds transferred from the MetLife annuity. Mrs. McNulty instructed Kingdom Trust to purchase 375,000 membership units of Greenhill at $1 per unit for an investment of $375,000. The funds for the purchase were wired from the IRA to Greenhill's bank account. Mrs. McNulty then had Greenhill purchase 320 1-ounce American Eagle gold coins for $374,000 from Miles Franklin, and $374,000 was wired from Greenhill's bank account to Miles Franklin. Miles Franklin shipped the coins to petitioner's residence, addressed to Donna McNulty, Greenhill, where they were stored in the safe. The second Greenhill investment and American Eagle coin purchase occurred in late January through February 2016 with IRA funds that had been transferred from the 401k. Mrs. McNulty instructed Kingdom Trust to purchase 43,274.70 membership units of Greenhill at $1 per unit for an investment of $43,274.70. Kingdom Trust wired $43,274.70 from the IRA to Greenhill's bank account. Mrs. McNulty had Greenhill use part of the funds to purchase 2,000 1-ounce American Eagle silver coins for $37,380, and $37,380 was wired from Greenhill's bank account to Miles Franklin. Miles Franklin shipped the coins to petitioner's residence to Greenhill, FBO, or for benefit of Donna McNulty, where they were stored in the safe. In August 2016, Greenhill used $6,731 of the funds remaining in its bank account from the MetLife annuity and 401k transfers to purchase 4 1-ounce American Eagle gold coins, 2 1/4-ounce American Eagle gold coins, and 1 10th-ounce American Eagle gold coin. A payment of $6,746 for the American Eagle coins plus insured shipping was wired from Greenhill's bank account to Miles Franklin. Miles Franklin shipped the coins to Donna McNulty at petitioner's residence, where they were stored in the safe. The third Greenhill investment occurred in November to December 2016. Around November 20th, 2016, Mrs. McNulty instructed Kingdom Trust to purchase 6,898.92 membership units of Greenhill at $1 per unit for an investment of $6,898.92. Approximately 1 week later, she instructed the custodian of her 401k to transfer $5,101 from her 401k to her IRA. Thereafter, $6,989.92 was wired from Mrs. McNulty's IRA to Greenhill's bank account. There was no purchase of American Eagle coins after this investment. Okay, so we go down further. All right, and here we get to the returns and audit section. It says, petitioners' 2015 and 2016 tax returns were prepared by a certified public accountant. The petitioners did not seek or receive advice from the CPA about the tax reporting with respect to their self-directed IRAs or their physical possession of American Eagle coins purchased using funds from their IRAs or the LLC through which Mr. McNulty's IRA held the condo. Nor did they disclose to their CPA that they had physical possession of the American Eagle coins at their residence. I suppose if they had told him, he would have warned them that there was a potential problem. So, on October 30th, 2018, the respondent, that is the commissioner of the IRS, issued to petitioners a notice of deficiency for 2015 and 2016. And a deficiency basically means they think that they owe taxes, in which he determined that they each received taxable distributions from their IRA that they failed to report. He also determined that they were liable for Section 6662 and B and 1 and 2 accuracy-related penalties for both years. In other words, they're coming after them to fine them for underreporting income. So for underpayments due to substantial understatements of income tax, and alternatively, negligence or disregard of rules and regulations attributed to their failure to report the distributions. He determined that petitioners each received taxable distributions upon their receipt of the American Eagle coins equal to the cost of the coins, including, with respect to Mrs. McNulty, taxable distributions of $374,000 and $37,380 for 2015 and 2016, respectively. So here's the discussion of the justification here for the decision of the court. And they say, for purposes of Section 408, an IRA means a trust created or organized for the exclusive benefit of an individual or his beneficiaries, but only if the written government instrument creating the trust meets certain enumerated requirements. Section 408A, in other words, one requirement is that the IRA must be a trust that is administered by a trustee that acts as a fiduciary. Mrs. McNulty's IRA is a custodial account. A custodial account may be treated as a trust for purposes of Section 408 if it satisfies the requirements of Section 408A. The trustee must be a bank as defined in Section 408N or such other person who demonstrates to the satisfaction of the Secretary that the manner in which it will administer the trust will be consistent with the requirements of Section 408. For a person to qualify as a trustee, the person must demonstrate by written application to the Commissioner that it meets the requirements set forth in the regulations for a trustee. Okay, so I'm going to stop reading here. So basically, there you have it, folks. If you're going to be setting up a self-directed IRA, you basically have to have a trustee that can be certified that they meet the requirements of the code. In other words, they would have to act as a fiduciary and know all the rules and regulations. So in this case, the courts have found that Mr. and Mrs. McNulty did not meet this requirement. And so they overturned the IRAs that were set up to hold the gold and silver coins, and thus all of the deposits into the IRA were basically nullified, basically leaving the McNultys with gigantic taxes and penalties that are now going to be due. Okay, so how the IRS figured this out, I really don't know. How they figured out that the returns ought to be audited. It was probably due to the IRAs themselves being set up and funded with large amounts, and maybe they started to question where the funds were coming from. It obviously was not a trustee to trustee direct transfer. But anyway, the main message of this video is, one, don't take chances when it comes to the IRS. I mean, the IRS has a lot of power, they have a lot of oversight, and they can seize your assets. And two, don't trust a lot of these companies that tell you that you can set up a self-directed IRA and store your own gold and silver coins. I don't believe it can be done. It's a very, very tricky thing. And in this case, basically a couple that decided to do this has found that the IRS has overturned their IRAs and is basically charging them taxes and penalties. And now the courts are holding up the decision. So be careful, folks. This is really not something to mess around with. And if you really want to hold gold and silver coins, honestly, there's really no reason to use an IRA for doing that. Taxes aren't going to be due until you sell them, and if you sell them in years when your income is going to be low, you're going to be finding that your tax liabilities are very low themselves. In fact, if you go back and take a look at my video called the mythical 28% collectibles tax, it basically goes through and discusses all of this. So you can follow along with how the taxes are calculated, and you'll see for yourself that they can actually be quite low. So anyway, that's all for today. I hope everyone has a nice weekend. All right, bye everyone.